Welcome to The Explainer, where we break down complex topics using the source material itself. Today we're diving into a new project called Walrus. And it's this wild mix of some really groundbreaking tech, insane market speculation, and some very, very real dangers for traders. Okay, let's get into it.
So let's kick things off with this quote, because honestly, it just perfectly nails the problem Wallace is trying to fix. The whole promise of Web3 is decentralization, right? But if the data for your unstoppable app is just sitting on some company's centralized server, well, it's not really unstoppable then, is it? It kind of defeats the whole purpose.
Okay, so to really get why a project like Walrus even needs to exist, we've got to understand the current landscape. Who are the big dogs in decentralized storage right now? And more importantly, what's wrong with them?
Right now, the space is pretty much run by two giants, Filecoin and Arweave. But look, they both force you into a really tough spot. Filecoin gives you massive scale, but it does that by making something like 25 copies of your data. That's super slow and gets really expensive. Then you have Arweave, which offers true permanence. You pay once and it's stored forever. Sounds great, but it costs a fortune and it's totally inflexible. What if you need to update a file? Too bad. You're stuck.
And it's exactly this dilemma, this pick-your-poison situation, that opens the door for a new player. So, in comes Walrus, claiming they have a much better way. Let's pop the hood and see what they're actually working with.
The secret sauce for Walrus is this tech they call red stuff erasure coding. Now, instead of making dozens of full copies of a file, it uses some really clever math. It chops your data into these tiny pieces they call slivers, and then it creates these redundant mathematical fragments. This means you could lose a huge number of the computers storing your data, and the network can still perfectly rebuild your original file, but with a tiny fraction of the storage space.
And here's how it stacks up on paper. That 25x redundancy for Filecoin, it drops to just 4 or 5 times for Walrus. Getting your files back goes from taking minutes to less than 2 seconds. And the cost, it's just dramatically lower. Now the big catch, of course, is maturity. Walrus is the new kid on the block. The network is still small, and it's got a lot to prove when it comes to long-term stability.
And like any Web3 project, this whole thing is powered by its own crypto token. In this case, a token called $WAL. It's really the fuel for the entire system. You use it to pay for storage. The people running the storage nodes have to stake it, kind of like a security deposit to make sure they behave. And if you hold the tokens, you get to vote on where the project goes next. It's a pretty classic crypto setup.
So the tech sounds pretty impressive. But the second you turn away from the white paper and look at the trading charts, the story gets a whole lot messier. The market's reaction to the WAL token has basically been a masterclass in confusion.
On one side, you have traders looking at the charts and just seeing total weakness. They're pointing at moving averages, momentum dropping off, and they're screaming short opportunity, a bet that the price is about to tank. And then, on the complete opposite end of the spectrum, you have this. Just pure, simple, unfiltered bullishness. A thumbs-up emoji. No complicated charts, no deep analysis, just the gut feeling that this thing is going up.
And of course, you get the timeless market wisdom, a friendly reminder that no trend lasts forever. Which, you could take that as bearish, or just as a general caution. It's not exactly something you can build a strategy around, right?
All of this conflicting noise leads to the single most common question you'll find on any crypto social media feed. Just honest confusion from someone trying to make sense of all the chaos and figure out what on earth to do next. And the result of all these competing signals is, you guessed it, just extreme volatility. In one 24-hour period, the price of WAL swung nearly 56%. That is the kind of price action that can make fortunes and absolutely wipe out accounts in the blink of an eye.
So, with all this chaos, how do people even attempt to make a rational decision? Well, they turn to this thing called technical analysis, using a whole toolkit of indicators to try and force some kind of order onto the randomness. These are some of the classics. Traders will look at stuff like the Relative Strength Index, or RSI, to see if something's overbought or oversold. They'll watch moving averages to try and figure out the trend. The whole goal is to find patterns in past price data that might predict the future.
But here's the catch. These tools are not objective truth. One trader on Binance Square can look at the charts and yell, "short opportunity." And at the exact same moment, an automated analysis on investing.com, using a lot of the same indicators, can spit out one word: buy. So the key takeaway here is, even the tools designed to cut through the noise often just end up adding to it.
And this leads us to a much darker question. What if all this crazy price action isn't just people disagreeing?
What if some of it is engineered on purpose to make you lose? This is where we get into the world of crypto trading traps. You ever have that feeling? The price drops just enough to hit your stop loss, kicking you out of a trade, and then it immediately reverses and shoots up without you? That's not just bad luck. It's often what's called a liquidity sweep, where big players intentionally push the price to these obvious levels to trigger a flood of stop orders, creating the liquidity they need to fill their own giant positions. And then there's the bull trap. This is pure psychological warfare. The price smashes through a key resistance level, and everyone on social media is celebrating the breakout. So your fear of missing out, your FOMO, kicks in. Retail traders pile in, buying at the top. But the whole breakout was fake, engineered on weak volume. The momentum just disappears, the price crashes, and all those new buyers are now left holding the bag.
And this is exactly why these traps are so effective. They exploit our own psychology. These big players know we're prone to FOMO. They know we tend to follow the herd. And they know that after a big loss, we're tempted to revenge trade to try and win it all back. They don't just play the charts, they play the player.
And look, don't just take my word for it. The data is clear, and it's pretty sobering. A massive study from the Bank for International Settlements looked at crypto app usage in 95 countries, and it confirmed that the vast majority of regular people who try to trade these markets lose money. And you can guess who's on the other side of those trades.
Which brings us right back to Walrus, and really to any crypto asset you might think about trading. You've got this promising new technology on one hand, and an absolute battlefield of market manipulation and psychological traps on the other. So you have to ask yourself a very serious question before you click buy or sell. In a market like this, are you the trader or have you become the trade?